Hey everyone, my name is Eric Bond, and I'm one of the co-founders at Hustle Fund, which is an early stage venture capital fund. And welcome to today's session, which is called Understanding the Secondary Market in Venture. So I'd like to start with a confession. When I began as a VC about 6 years ago, if someone had asked me what a secondary was, my response probably would have been something like, is it what happens after a first year? Okay, if you're still logged in, I realize that my mom and dad jokes don't always land. But what isn't a joke is that secondaries are such an important part of the venture ecosystem, yet they still remain elusive. And they are even confusing to VC managers as well. The marketplaces behind secondary transactions are vague, with non-obvious buyer and seller approval processes. And yet, these transactions represent a $4 trillion asset class. That is trillion with a capital T. So if you're an early employee at a top tech company thinking about selling your shares via secondaries, or maybe you're an investor trying to navigate secondary liquidity, you are in for a treat today, because today's webinar on understanding secondaries will cover these topics. We're going to talk about what they are, why they are interesting, how do you do these deals, what unique opportunities are happening now in this market, and also understanding the risks. So I just got to actually provide this disclosure because we got to cover our butts, which is that we're talking about securities. There's no solicitation that's happening in this call. We're not providing any legal advice. This is just a conversation among friends in this closed room of 400 people. So wanted to get that out of the way. And we will have a great discussion about these topics with our guests, whom I'll introduce in just a moment. And we will leave some time for Q&A at the end, roughly 10 to 15 minutes. So if you have a question, I please urge you to direct those questions to the Q&A section of the Zoom webinar, and we'll cover as many as we can. And if you're on the chat, feel free to chat, make fun of me, my garage, all that stuff, but also introduce yourself and maybe tell us where you're calling in from. Now I'd like to introduce our illustrious guests. And I would like to start with my amazing colleague, Jamie Melzer. She is the managing partner and general partner, GP, at Hustle Fund Scale Partners. This is the growth and late stage opportunistic investment platform affiliated with early stage venture capital firm Hustle Fund. Oh, that's me. Hustle Fund Scale invests in Series B through pre-IPO venture-backed companies through both primary rounds and secondary transactions out of its fund and co-investment vehicles. Jamie has over 17 years of experience investing across asset classes, including high yield and distressed debt, public equities, and venture capital. Before joining Hustle Fund, Jamie was at Brigade Capital, where she deployed $2 billion across their hedge fund and opportunistic strategies. And before Brigade, Jamie was a 2-ranked high yield research analyst, which is a senior role, if you don't know, at Bank of America. So very excited to have Jamie here, and she's going to be joined by our other amazing guest. I call her the queen of secondaries, but she's also known as Andrea Lamari, who is the general partner at Manhattan Venture Partners, known as MVP, a venture fund with north of $1 billion of AUM with an investment thesis focused on secondary direct investments in growth and pre-IPO companies such as Klarna, SpaceX, Epic Games, and Flexport. These are all great mom and pop businesses I've heard of. That's excellent. As one of the first female executives in this space, Andrea has been shaping the landscape of the private company liquidity environment for over 10 years, beginning her career as the co-founder of Forge Global. That is a publicly traded company on the New York Stock Exchange under FRGE, which is one of the largest secondary marketplaces and the first to go public. And prior to joining MVP, she led the Carta X team at Carta and worked on NASDAQ's pre-IPO and secondaries team. Andrea has supported more than 100 late-stage private companies and has facilitated over $10 billion worth of secondary transactions for mid to late-stage private companies. Wow. Okay. So I am the underachiever of this group, and I would love to actually begin with Andrea. Yo, Andrea, you are the OG of the secondary space. Can we first start, though, with some of the basics around, what is a primary versus a secondary? What are the key differences, and how should we even think about this asset class?
Sure. So thanks so much, Eric and Jamie. Love the Hustle Fund team. Love partnering with you guys. Love to call you friends and confidants. So I'm so humbled to be here. And we'll kick this off, right? So let's really, I think, first set the stage, which is what is a primary and then what is a secondary, right? So I think that's a super core just principle here so we can kind of wrap the context of the conversation. So a primary occurs, right, when a company, a venture-backed company who raises venture rounds of financing, goes out, they raise in series A, B, C, D, etc., right? The company itself issues stock to the investors who participate in the round of funding, which is typically referred to as a primary round of funding. Now, secondaries or secondary transactions, this is what we're going to be talking about today, occur when an investor buys the stock that has already been issued, right? So what we're talking about is the transactions that are occurring between stock of employees or investors that hold it. And what they're doing is selling it, right? And they're selling it to either new investors or existing investors of the company. And those investors are simply taking that stock and it's now changing hands by way of the transaction, right? So we're going to be talking about those secondaries. And if you think about the public markets, right? Virtually every transaction that occurs within the public equity markets outside of an IPO is done through secondary transactions, right? When you buy shares in Apple, you aren't buying new shares from the company typically, right? Or they're negotiating the price of the company. What you're doing is you're actually buying and negotiating with existing holders of Apple stock by way of your trading of that stock. And Apple simply updates its stock ledger after the transaction, which is effectively the same as a cap table. And that reflects the change in ownership, right? So we've got cap tables for private markets. And then once you go public, it's really treated as a stock ledger. Secondaries occur in the private markets as well, right? That's what we're going to be talking about today. But without a centralized marketplace for sourcing, pricing, and transferring the shares. And the process is much more complex in these kind of private markets. And we're going to dive right into that, right? So I want to note that you're going to say, well, this is probably going to lead into a lot of discussion around why don't you hear of all venture funds doing the strategy of investing into venture secondaries, right? Well, the whole thing is that there's something called the venture capital exemption, right? So most VC funds really, just by way of the rules, right? We don't make the rules, we just have to follow them. They can't just deploy all of their capital into secondary transactions, right? There are rules around establishing as an RIA, a registered investment advisor, if you're going to have a thesis that is predominantly focused in forms of alternative assets, such as secondaries or even crypto. And there really are only a small handful of well-known venture funds, such as groups like Andreessen Horowitz or Sequoia Capital, who also, by the way, if you're going to be wanting to trade or hold it going further into the public markets, once your startup portfolio companies go public, you also need to register as an RIA. And there's just a lot more legality. There's a lot more red tape with operating as an RIA. There's reporting requirements as well. So that's why you don't hear that outside of a few other functions of this venture capital exemption, it's not a thesis. Like investing in secondaries isn't necessarily a thesis that most venture funds could deploy predominantly, okay? And when people talk about secondaries, and I think this is something we're going to brush on very quickly to kind of get into the meat of the fun stuff, but what they're talking about when it comes to secondaries are either GP or LP-led secondaries. And what we're going to really talk about is a specific function of that, right? And so GP and LP-led secondaries encompass virtually all kind of closed-end fund structures, including like private equity and real estate credit hedge funds, stuff like that. And venture actually composes a very small part of like the entire secondaries market, right? You've got, like I said, these other functions of asset classes where there's LPs and otherwise that are trading the interest between each other. And that's also called secondaries. So that's where I know colloquially, what we're going to do is really distill our conversation today around the transactions that happen between folks in venture. And what we're doing is talking about the buying and selling of really startup stock, right? And so overall, what we're excited about, and this is why we love partnering and being such good friends with you guys at Hustle, is that I think we share a really similar focus and drive, which is that we focus on opportunities in these direct secondaries in venture-backed companies that are really typically late stage in nature. And we're going to talk about why the concentration is so late stage. But these shares that we're kind of talking about, and we're going to have some illustrative examples during the discussion, are companies you're going to recognize, right? SpaceX, Epic Games, Klarna, Databricks, Instacart, Stripe. Like these are companies that are, I don't want to say very actively traded because we're not talking about the level of trading volume as public markets, but it's pretty substantial and it all happens a bit in a bubble, right? So or a vacuum, I should say. So we're going to talk about that in nature specifically. I will turn
fun fact, just quickly, on the venture capital exemption that you mentioned. So I googled this. There's something like 1,000 VC companies in the US. 2% of them are RIAs. 98% of venture companies in the US are not registered investment advisors. So as you mentioned, they really can't participate in any kind of large scale in the secondary markets or crypto, fund of funds, public equities, et cetera. But it's just an interesting dynamic because the big kind of growth in late stage venture players that often know these companies the best are actually not the natural buyers in the secondary market. So it's just an interesting thing that kind of limits competition in secondaries versus maybe growth venture or public equities. So just a fascinating data point.
I think you make a really great point here too. Just so as like a GP at a VC fund, this is, I think, one of the contributing reasons why this is so elusive to us. Because of the lobby of the NVCA, it's made actually the lives of being running a VC fund to be fairly simple when it comes to like the regulatory, the compliance, and all that stuff. Secondaries kind of like move into this strange kind of realm of RIA stuff, which is like for me still a bit of a black box. Which is why we actually started this call in an unusual way, talking about this is not solicitation, legal stuff. We almost never do that at Hustle Fund sessions like this, but we have to for this one because it's really difficult to talk about these things publicly sometimes. But I want to get a little bit more click down into this topic. So question for you, Jamie. Can you speak a little bit more about some of the trends that are driving the late stage private secondary markets?
Yes, absolutely. And if you don't mind, Eric, I'm going to pull up some slides because I have a lot of numbers to talk about. And I feel
we
like
love data.
some visuals would be helpful here. So let me see if I can do this.
Didn't see this one coming.
Eloquently. Okay, here we go. This is where we are. Oh no, it's not working. There we go. Oh, this is the disclaimer that we mentioned before. Okay, here we go. Okay, so context here for everything that we are kind of about to talk about. And thank you, Andrea, for the awesome intro and overview. Okay, so we are really just on the other side of 13 years of historically low interest rates and quantitative easing. In a low return, no return kind of environment, capital naturally flows up the risk curve, up and to the right, maybe that way if you're on the other side of the screen, into higher risk and potentially higher return asset classes like private equity and venture capital. So from 2007 to 2022, really starting like 2009, kind of as we came out of the global financial crisis, we saw 10x growth in venture capital as an asset class. So the trends that I'm about to talk about are a direct result of a few $1 trillion of capital flowing into a relatively small asset class over the last 15 years. So trend number one, companies are staying private for longer. So Facebook, Apple, Amazon, Netflix, Google, NVIDIA. Do these companies sound familiar? Yes.
I might have heard one of them.
So the first five were the kind of old school FANG stocks. I think they've been replaced by the Magnificent Seven now. But these stocks collectively make up 15% of the S&P 500 and like 30% of the NASDAQ. If you look at the Magnificent Seven, it's like 30% of the S&P, right? These are tremendous value. These were all venture-backed companies, and all of these companies IPO'd within 6 years of being founded, with the exception of Facebook, which IPO'd after like 8 years. So going back to the mid-2000s, the average time to IPO for a venture-backed startup was 5.5 years. Today, the average time to IPO for a venture-backed startup is 12 to 13 years, and due to a number of factors, including easy access to capital in the private markets, my notes, and I would say a misalignment of interest between public market investors and private companies and kind of longer term goals. I think that number is likely to keep growing or at least stay at this kind of extended level. And that is on average, which means many companies are taking much longer than 12 years to exit. So trend number two, private valuations are getting bigger. These go hand in hand. So Amazon, Netflix, Nvidia all IPO'd at less than $500 million valuations. And the average IPO valuation in the mid-2000s was $200 million. So this is basically like a small Series C today, right? Everything beyond kind of Series C didn't really exist. There really was no late stage venture market. Today, the average venture-backed company IPOs at $3 billion, and many of the best venture-backed companies like Snowflake and Airbnb, Roblox, Uber, et cetera, IPO'd at over $30 billion valuations. So the combination of these two things, companies staying private for longer and private valuations getting bigger, has created a new late-stage private asset class that largely did not exist 10 or 15 years ago. And so there really was no need for this secondary market. The secondary market has evolved out of a need for liquidity in this multi-trillion-dollar asset class. So quickly, okay. So again, going back to 2008, there were roughly 18 venture-backed companies valued at $1 billion or greater. The term unicorn was not even coined for another 5 years. Today, that number is close to 1,300 companies, with an aggregate market valuation approaching $4.5 trillion as of last run valuations, or kind of the peak of the market. Today, at kind of mark to market or where prices are transacting, it's probably closer to $2 to $2.5 trillion. That's trillions of dollars of value that just didn't really exist as an asset class 10 or 15 years ago. So all of this is just to say that there is a tremendous value accruing in late stage private markets that used to be accrued by and accessible to public market investors. Trillions of dollars of value. In fact, you can see in the chart on the right here that as this late stage asset class has grown, so is the number of stakeholders seeking liquidity in the secondary markets. So how do we as investors get access to these private companies, and how do we take advantage of the market correction, which I'll flip down? You can kind of see the trends over the last kind of 18 months. How do we take advantage of this market correction to invest in these late stage private companies at valuations that are now sometimes 50 to 80% below last round valuations? So I will pause there, and that's my kind of data presentation. I'll stop these for now and pull it back up when we need it.
That's awesome. It's really cool to see this distillation of all these data. And if you're furiously screen capping Jamie's slides, don't worry about it. We're recording this session. Okay, we're gonna send this to y'all later. So just sit back and relax. So really cool background, and I'd love to actually kind of instigate a bit of a conversation here. I'd love to can you two talk about how we should think about investing in secondaries relative to public markets or traditional venture capital, because we have a lot of investors in this audience today. And maybe Andrea, I'd like to start with you on that.
Sure, yeah. Well, so when kind of assessing whether to invest in these kind of late stage companies and the opportunities that then come with that, right? And what is that entry price? When do you get in? There's a lot of discounts now, right? There's a lot of folks that, hey, the markets have changed, the tides have changed. So overall, it's created some pretty compelling opportunities to invest in late stage companies that otherwise are pretty hard to access. And we're really going to kind of talk about now the difference between late stage, right? The kind of companies that are about 12 to 24 months away from an IPO and not actually distilled down into mid or growth stage. So a very fair diligence question, right? When we're speaking with folks at Manhattan Venture Partners, when we work with people, we have our principal venture funds that deploy, we do a lot of co-investing, and then we own a broker dealer. So what that allows us to do is also use the broker dealer function to kind of trade into these securities and really help people kind of determine their own entry price outside of our own fund structure. And so when we're talking about that, we're talking about whether the investment into maybe a late stage secondary is something that they're going to look at as either an investment, right? You're looking for multiples, IRR, DPI, right? All the good fun venture metrics. Or is this something where that investment into that late stage company is something you're going to treat as more of a trade? And with that being said, when you talk about that, you see investors who really consider various forms of hedging strategies, right, against their existing portfolio. Those are the folks who are really kind of thinking about this as a trade, right? They might have something as a diversified way of their other holdings, and they're saying, hey, I'm going to do this kind of late stage venture secondary stuff with you guys because it's considered a trade, right? There's some sort of aspect behind it. With late stage companies, considering where the public comps are, right? The public comparables, our trading is really going to be something we see as key as part of the diligence process, right? Overall, it's the question of, do you invest in Stripe now? And Stripe has created some really compelling kind of entry pricing right now in the secondary market. Or might you buy the public comp being an Adyen, right? Adyen is another phenomenal financial services company growing at an exponential rate. Granted, I mean, there's been a little bit of volatility there over the recent weeks, but overall, it's an illustrative example of one of the companies where you're saying, am I buying Stripe now? Do I still see upside, or do I see more short-term kind of trade opportunities? Or am I buying the public comp? And overall, what is the investor's goal? Is it around your diversification, your risk tolerance, your excitement, you name it? So I think that's what's really key here. And then Jamie, if we can pull up that MVP, the slides there. What we'll talk more about next is actually a really interesting report we published at MVP recently. So when I say recently, I mean in the last 18 months. So what we did was on our research team. So under our model as a platform of MVP, we have our fund, I said, broker-dealer. We also have Manhattan Ventures Research, which publishes research on late-stage venture companies. And what we did here was that we actually examined 175 companies who went through a traditional IPO from 2011 through 2022. And overall, we did also remove a few outlier companies that had untraditional characteristics as well. And, you know, for example, were they more levered with like private equity capital with some flavor of venture, but more so on the PE side? So just to give you an example there of what outliers we removed. But overall, what this slide shows, and I really want to drill down, you know, overall there's the time of funding round increasing through 2021. But if you look at the bottom, right, I think this is where it's borderline controversial, right? And I you know, love you guys at the early stage Hustle Fund side, but this is going to play team Hustle Fund scale on the team Jamie side, which is what the bottom chart represents is that our data shows that investing, right, going into the series F, G, or H rounds at the time of the alpha then generated from investing by way of entry into the F, G, or H, or a function of secondary investing into the F, G, or H, created a higher return profile than at the series A through E, which is just so interesting, right? So I think just generally, you know, there's a belief that amongst the venture ecosystem, investing in the early stage has this kind of exponential outsized returns capabilities, which it certainly does, right? In many instances, you might pick one winner as an early stage fund that returns your entire fund. But what we found in this data set is that it's really fascinating that it didn't necessarily prove the contrary, but it showed that investing in the late stage can definitely kind of lead to outsized returns depending on your thesis overall.
This is super interesting analysis, Andrea, and I'm guessing, I don't have the underlying info in front of me. I'm guessing on like a multiple basis, those early stages still return kind of higher multiples on capital, but because it takes so long to get to an exit at this point with the 12 to 13 years to IPO, that the actual return on capital over a short amount of time can be just as compelling or more. So that's super fascinating. So I can jump in and give a slightly different kind of perspective on this if it's helpful, Eric. So if you think about the public markets, they're big, they're transparent, they're accessible, and they are efficiently priced. They might not be correctly priced at all times, but they are efficiently priced, right? Everyone has equal access to information from a regulatory standpoint, like fair access to information, and the ability to buy and sell. So both information and sentiment, bullish and bearish, are priced in literally by the second in the public markets. Meanwhile, in the private markets, markets in kind of in quotes here, doesn't have any of this. There's no centralized marketplace for sourcing or price discovery. There's no major banks creating a market for direct secondaries. There's very few institutional funds involved, and many that we mentioned, growth equity funds, that can't even play big in secondaries due to regulations, and really very little regulation around fair access, financial disclosures, or things like material non-public information that exist in the public markets. And so there's limited competition relative to public equities, and even fewer players who can get access to information and get approved to come onto the cap table and transfer shares directly. And so all of this creates a market that is opaque, inaccessible, and inefficiently priced, which is what creates the opportunity to generate outsized returns relative to the risk that you're taking on. And I think this is one of the most important points, right? Because really the entire goal of active investing is to outperform the markets on a risk-adjusted basis. So at the later stage, many of these companies have been around for 10 plus years now. They're doing hundreds of millions or billions in revenue. They're profitable or getting close to profitability with an extended runway. They look much more like mid and large cap public companies from a size, stage, and risk standpoint. So this is not early stage venture like risk anymore, where something like 90% of companies, at the pre-seed or friends and family level ultimately fail. The default rate for the latest stage private companies, pre-IPO companies, is like 4%, which is much more comparable to public equities. It's really the lack of transparency, the limited competition, the asymmetric access, et cetera, that we've been talking about, that creates the potential for venture-like returns without necessarily taking on venture-like risk. You're still taking on private market liquidity risk, and you should be compensated for that, but you really aren't taking on true venture risk at the company level anymore. Quickly, let's see if I can click down here. Okay, quickly on this. So the last thing I'll mention on the kind of like public versus private aspect. I think we're at a unique inflection point in the markets that makes late stage secondaries very interesting relative to public markets today specifically. So going back to like spring of 2022, public equities really started to roll over and saw a material sell off. Privates took another like 6 to 12 months to really capitulate and prices to reset. Secondaries are now trading an average 50% discount to last round valuations. I think they bottomed in like May, June at like a 61% discount, what was actually transacting from last round valuations. So year to date, 2023 now, we've seen a material rebound in the public markets that we've not yet seen in private secondaries, or are just starting to see across a few names. So for the first time in years, you can actually buy many late stage private companies at a discount to their public comps on both a valuation and a multiple basis. And I will say secondaries are an inefficient market, but I would expect this arb to close over time as capital kind of flows back into the most, compelling opportunities. So with that, I think I'll exit out. Oh, I already did. Never mind. You guys aren't seeing the screen. Hang on.
No, we didn't, but we got the point. And actually, yeah, thank you for flashing that data.
This is the chart I was talking about.
It's really interesting because this, I think, is nailing the most interesting part of the entire secondaries world for me personally, which is, if I'm going to try to like battle it out as a public equity trader, which I would never do because I would not win, but like the information is too transparent. Like finding like the alpha, I guess, with I guess like information that's so public is very difficult to win that game, and some people do it. But it sounds like there are more opportunities for that in secondaries, right? Where there's some qualities of like the late stage trading that are available to it, but the opaqueness, I guess, opacity, I should say, is there where, a lot of information arbitrage is possible. And I'd love to actually get an example of specifically the pricing inefficiencies or opportunities that you may be seeing in the secondaries market. Is there like a company that comes to mind for you too?
There are many companies that we can talk about. I think we'll touch on one that I think a lot of people are familiar with, a consumer-facing company called Epic Games, which we've invested in. Andrea, I know you've invested in it. We've invested in it together. We've invested separately. And I think it's an interesting example that we can kind of touch on. So let me share this kind of like high level, which I like for the price chart here.
Yep.
So I'll start, and Andrea, please feel free to kind of jump in and add to this. But so Epic Games is a top 3 gaming company alongside Activision, Blizzard, and Roblox. They're the creator of Fortnite, which I think many people have heard of. They have something like 400 million active users. So Epic peaked in early 2022 in the private secondary markets at like a $50 billion valuation. The company's now trading and available in the secondary markets at $4.35 a share, or an implied equity valuation of around $14.6 billion. And keep in mind, they have about $4 billion of cash on the balance sheet, give or take. So this is really on an enterprise value basis, like $10.6 billion. That's something like 2.5 times current year revenue. And if you look at the comps like Roblox trading at 7 times current year revenue, or Activision, which is being acquired by Microsoft. I think it's finally going through for $75 billion, or like 8.5 times current year revenue. Epic, I think, is priced really attractively. It's not without risk, has some kind of diversification issues that it's, I would say, growing its way out of. But I would have to think, and this is not an investment advice, that in the public markets, I think they would be trading at a higher multiple than that. This is just my take. So if you look at like the last several round valuations, which is on this price chart here, Epic is actually back down to like 2018 or early 2019 pricing. It is now trading below the last 4 rounds of valuations, including the $2 billion that they raised from Sony and Lego, which are strategic partners.
And Jamie, on this note, if I may just quickly,
yes,
I think what's so key here is what you mentioned, which I just want to put like a massive, exclamation point around, which is, as you said, where we saw it trading at the very high, the very peaks, right? So far in the secondary market was effectively an implied valuation of $50 billion. The company last raised capital at a $31.5 billion valuation, right? So that's representing such a massive premium for this asset in the secondary market. And overall, and we'll kind of go back to you, which is like the fact that it's now trading at sub 2018 levels, 4 rounds of funding ago, is just such an interesting data point around the entry of companies like this and the strategies of secondary market investor. If you're looking at stuff like this, which is, where am I going to buy? What is the right time, place, and opportunity for where the market is willing to bear the pricing? And overall, there are obviously strategies when you're buying and selling into secondary to say, should I be dollar cost averaging this position, buying it at different entry points, depending on what the market could bear for when the opportunity arises?
Yeah, that's an interesting point. And what else was I say? Andrea, I mean, this is not a distressed name, right? Like there are some kind of distressed names in the secondary market where we're seeing them trade down at 80-90%. They're going to be raising massive down rounds or structured rounds, things like that. Epic is not one of those names. Like, it is a healthy company. It's been around for over 30 years. They've got $4 billion of cash on the balance sheet, really, really strong investor base. Like, this is a company that's likely to go public in the next 3 to 4 years, right? Do you think?
I would say so. And I would say alongside that, Jamie, is that overall, then the question is necessarily, like, why is there pricing inefficiency? And so, as you said, it is a 30-year-old business. They've had a lot of employees and shareholders over time. This is an amazing company out of Raleigh, North Carolina, that we are very humbled to have in our portfolios alongside you guys. And you go down to that business, they have a ton of employees. They've scaled very quickly, and they say, listen, we've been very generous as a business to reward their shareholders and employees with great equity packages. And the company's been very friendly to secondary market transactions over time. So with that said, it's created some really compelling opportunities, but it also means that this is one of those companies in the secondary market that has enough trading volume over time to really examine the data over the duration you're discussing.
Yeah. Can I add a comment to this too? This is a fascinating discussion, and this is the perspective of an early stage venture capitalist. So if I were lucky enough 30 years ago, when I was 12 years old, to be one of the angel investors in Epic, right? And I was running the fund. A fund's life, in a traditional fund life, is 10 years with maybe 1 or 2, possibly 3 years of extension, right? So the social contract that's being set with investors, my investors, is that we're going to try to return as much liquidity as possible, generally in the second half of the fund's life. But if this is a company that hasn't IPO'd and it's been 30 years, secondaries are very attractive for a GP like myself, because I might be able to capture 50, 100, 200, 1000x gains before the company has even IPO'd. That's when I would speak to Andrea, Jamie, just like to get a sense of like what I can do to navigate this stuff. And it's interesting because like some of these early investor pressures with these IPOs that are extending well past a decade now are producing these kinds of opportunities where these shares are now suddenly available. Which is why I think this is so fascinating for me to listen to this conversation.
And I'll add one final point on Epic, which I think will lead into our next kind of set of conversations on risks and structure and things like that. An interesting thing about Epic is that the entire cap structure is common shares. And this is very unique to Epic. This is almost non-existent across the rest of, I would say, the venture ecosystem. And I think it's because Epic's been around for so long, it just is kind of a different beast. But because there's only a single class of shares, you don't have to worry about the liquidation preferences or terms or structure of the series B, C, D, E, F, G sitting on top of you. So when you're thinking about, like, figuring out the right price to enter a company, you often have to think about, okay, am I coming in common, or am I coming in Series D preferred? What is my downside? What's my liquidation preference? Like, what is the water going to look like before I get paid out in an IPO or an M&A scenario, things like that. You don't have to worry about that in this particular company, which I think is really interesting. You can kind of just buy in. You can buy from an employee, you can buy from an early investor. It doesn't really matter. Whereas when you're doing that analysis in virtually every other company, when you're coming in as an investor looking to buy, it is a much more complex diligence process and kind of exercise to figure out the right pricing for the additional levels of risk you're taking on, coming down to kind of early, preferred, and common in the cap structure. So
that's why we pay you two to figure this stuff out, right? I mean, like, for myself, it would be way too crazy to just spend time on a Saturday trying to understand all this stuff. But fortunately, we have these two incredible GPs here. And if you did come late to this conversation, we are speaking to Andrea Lamari, who is the GP at Manhattan Venture Partners, and Jamie Melzer, who is the GP at Hustle Fund Scale. So we're having a great lively discussion around secondaries, understanding this market. In about, call it 8-10 minutes or so from now, we're going to have an open Q&A. So if you have any of those questions, I see some coming in, please direct those to the open Q&A or the Q&A portion of the Zoom webinar, and we'll try to get through as many as we can. But I have maybe like 2 more questions, and I want to direct this next one to maybe Andrea to share thoughts first, which is, all this great stuff said, how do investors actually get involved in the secondary market and shares of a company that they may be interested in? Like, mechanically, do you have some sense of how to walk through this stuff?
Absolutely. So I would say that entry, right, and kind of that opacity, that's what we're here to help you guys with, is there's really interesting ways to access, but you really have to kind of do your homework and figure out ultimately what you want. So I would say overall, right, of course, shameless self-promotion, but in a sense, you've got folks like Hustle Fund Scale, MVP, and what I always recommend is taking a look at our existing portfolios as fund managers, obviously published on the site and talked about in news, and say, hey, they might be invested themselves in one of the companies that I, as an investor, am interested in exploring, right? And then speaking around the entry from our perspective as principal investors, right? And saying, you guys are there, I'm interested, what should we do to kind of get in as well and share in that? Otherwise, there's a world of being able to access this market as an investor by kind of connecting with some of the online platforms, right? There's some platforms that act as marketplaces, such as Forge Global, where I was, or equities, and a few others, where you can really go in and kind of see how do I access those breakpoints? How do I see where the company is trading in the market? And I will say that the one thing that is a little bit different that I find between some of those marketplaces and effectively where some of us as principal investors play is that sometimes we're seeing some more of those kind of institutional size transactions play out that aren't necessarily captured by way of those marketplace products, that are doing kind of the more smaller dollar or otherwise more commonly known trading activity names. And so it's always a good idea to kind of get a sense of where the activity is, how to get access to the information so you as an investor can make sure you're having an informed decision around deploying, and then confirming and analyzing any data that you can find by way of the online resources to say, how and when should I enter this asset? Is there a compelling entry price that makes sense? And then Jamie, I would love to turn it over to you as well to see your take.
Sure. I mean, the way that I think about kind of navigating actually transacting in the secondary market is maybe threefold. So one is the supply side, right? Actually sourcing shares that you can buy, maybe from a broker, from a boutique investment bank, from a private seller like an employee, a founder, an ex-founder, an angel investor, or fund. And this is, I would say, very relationship driven. This entire business the secondary market is naturally more transactional than I think traditional venture, or is certainly viewed that way. But at the end of the day, it is actually a very relationship-driven business. So sourcing the shares, figuring out and negotiating the right price. And so what does that mean? Getting access to financial information to analyze the company, which is, I think, generally one of the biggest challenges in the secondary market. So what are the revenues, the KPIs, the burn, their future fundraising needs, like the fundamentals of the business, right? Like, what should I actually pay for this? And then the legal diligence. So like, what am I actually buying? So confirming and analyzing where you're coming in on the cap table. Is it common? Is it Series C preferred? You know, what are the terms and structure above and below you? And how do you price risk across all of those different tranches? And this is actually kind of my background. Like, distressed credit is effectively putting a valuation on assets or companies, and then running them through a capital structure of all of the different, you know, securities on there, whether it's secured debt, accounts receivable, unsecured debt, common equity, et cetera. And pricing risk across all of those different asset classes. It's effectively the same thing coming into the secondary markets, particularly when you are buying below the last 1, 2, 3, 4 round valuations. This really starts to matter, right? Because there are shares with liquidation preferences that are kind of comparable to like secured debt in the credit markets, that are going to get paid out before you at par, before you get a payout. So being able to kind of come in and run that scenario, run it through the waterfall, and figure out how to price the tranche of risk that you are looking at buying. How do you do that? You have to get access to cap table information. And then lastly, getting approved to actually come onto the cap table and transfer shares so that you don't get blocked or ROFR'd. And we'll go back to Andrea to talk more about that later. But those are kind of I would say, the 3 components. And really, on the sourcing side, it can be very relationship driven. On the access side, getting access to financial and legal information to due diligence and kind of price the risk that you're buying is very relationship driven, like relationships with the companies, relationships with existing investors. And then actually getting approved by the company to come on the cap table and transfer shares is also very relationship driven. And so I think that there are probably, you know, players in this market that have different relationships with different companies and kind of can be the access point to different companies. And you kind of have to figure out who you should be investing with that has those relationships and has the knowledge and can do that diligence.
Yeah. Actually, and so Jane,
go ahead, please, Andrew.
Oh, I was just gonna say, I mean, she said it so eloquently, but I would say, and knowing that we just have a couple more minutes before I know we want to turn it over to Q&A, but I think just something that I know, you know, between Hustle Fund and us at Manhattan Venture Partners, it's just, this is like such, I would say, my kind of closing remark on this, which is the following. That relationship you hold and that access into these private companies is just so paramount, right? What we all know, and I think we can all share and values by way of everyone as part of this discussion today, is private companies are private for a reason. They want to be able to grow at all costs, and they want to preserve, you know, the business and who's part of the business, right? Who are their investors? Who are their shareholders? And so if you're interested in investing in one of those late stage private companies, I think it's just so key, and it's something we value so much, which is, how do you get access? How do you ensure you're kind of following the baseline understanding of the company to get in and invest and do the secondary, do whatever, no matter what your check size or your history is. And I would say ensuring you have a bridge to that relationship to some of these companies is just so key. And I would say that's where I always urge other investors to spend as much time as they can, is really understanding what's the best way to do a secondary in a kosher way that won't just be disruptive to the company and will allow you to build a relationship with that company over time. So maybe they'll call you for the next round of funding or something similar. So I would say that's just something that we so value, and we really are humbled by the fact that Hustle Fund does the same.
You know, on that relationship piece, because I have seen some questions coming in on the Q&A about how do you actually gain access to these information? And it actually is sort of a testament to some of the behavior that I actually see the Manhattan Venture Partners team, specifically Andrea, do. Like, Andrea just materializes in the most random parts of the world. Like, I can be like some random restaurant in the Bay Area or New York or Nashville, and she's just like suddenly there. And I know you do that by design, right? Because like it's really about the multi-turn game of like building out like authentic relationships, non-transactional relationships, but like the authentic things. So I see it done, and I actually see it through the work that you do, Jamie, all the time. Like when you're talking to the COOs of some of these businesses, like those text exchanges feel, from how you describe it, more like, conversations with friends almost in some degree. And that takes a lot of work. As like a retail investor like myself, if I'm trying to like sell my Stripe shares or something, it's a little bit harder for me to like understand how to navigate, or maybe I just don't have the bandwidth or time because this is not my job. This is your job. So I wanted to call that out. And I did have one last question I wanted to pose before we open it up to the Q&A, which is, we got to touch on risk a little bit here. And there's some terms that I heard, like ROFR and things like that. Can you help us to define that? And maybe Jamie, you could start, and then Andrea can have the last word about the risks of this space.
Yeah, I mean, for the sake of time, I was kind of going to walk through like the common versus preferred and kind of figuring out how to price risk. I think it would be helpful for Andrea to walk through things like getting blocked by the company and ROFRs, and actually saw some questions in the Q&A of like, why are companies kind of protective of who comes onto their cap table? Why are some companies more protective than others? What the heck is a ROFR? Andrea, you're amazing at this. Like, take it away.
I'm sure. So I will say, just overall, hashtag goals, but I will say that my future yacht, I always tell people I want it to be named No ROFR, and you're going to hear why in a reason, in a second, I should say. But overall, the ROFR, right? So this is something, the right of first refusal, ROFR, okay? Every company has governance, every company has bylaws, every company is governed by a set of shareholder documents, amongst others. Overall, most private companies, I would say, give or take 99%, have provisions in their governing docs. Depending on which company, it might be in a various set of docs, whether the bylaws or the shareholder agreements that say, hey, listen, if you want to invest in the business, you're going to have to follow a set of rules, whether you're investing in the round or you're investing in a secondary. And overall, if you're going to invest in a secondary, the ROFR is usually spelled out in those documents, and there's parameters around the timing and the structure of which you propose the secondary to the company. So many companies, just as an example, have what's called a 30-day ROFR. What does that mean? A 30-day ROFR is that you effectively propose the transaction to the company. The company then preserves the right to have 30 days to evaluate the transaction. Who's the buyer? Who's the seller? What's the price? How many shares are being sold here? And they then have the ability in many instances to say, hey, as a company, a private company, we reserve the right to A, buy the shares back at the price that was indicated in this opportunity, or we as a company preserve the right to assign this entire transaction to a totally different investor to buy the stock from that seller. And I would say this is really important. These are the rights that private companies want to preserve and why they remain private. And so this is really important to know and navigate, which is, you can't just send a random email to the company and say, I want to buy your stock in a secondary and just hope it sticks. It really takes, a firm understanding of what the governance laws of the company say. What are those policies and procedures that allow you to go through with proposing a stock transfer with the company? And that in itself is an art of understanding and being able to, going back to my earlier point, just be respectful of the relationship of the business and get a sense of what should you do if you do want to buy direct stock. Now, just separately, going through a co-investment vehicle that many of us work with, right? That function of working with the company and going through that process definitely is something the manager of the co-investment vehicle is really responsible for doing. So if you're going into an SPV or a similar structure, you typically don't have to worry about navigating that company process. But if you're looking at doing some direct transactions where you're buying the common or preferred stock, that ROFR, amongst a few other things, are really key to bear in mind.
This is awesome. Okay, we have had a really, really great, I'm going to say graduate school level 101 on this world of secondaries. Thank you so much for spelling it out to naive investors like myself who are still learning about this space. And I did want to leave a little bit of time for some open Q&A, because I am seeing our Q&A section of this Zoom webinar filling with excellent questions. So maybe we can try to get to as many as we can. And the first question I'd love to start with is actually from one of our investors, Fernando Pontaza, who is the founder of Invariantes, an amazing, amazing fund. which is aside from a large fund leading a subsequent round and offering existing investors liquidity to buying their position, how do you initiate the process of selling a small position on your fund as you're approaching the end of the fund's life? Anyone brave enough to take that one?
I'll hand this over to Andrea because you guys do this on the brokerage side all the time, right?
Mm-hmm.
Sure. So depending, of course, on the fund structure and how that fund owns the asset. When I say the asset, I mean the shares of a private company, right? There are a couple things to think about, right? Is first and foremost, I definitely always recommend, if you're not the GP of that fund, please, contact that GP, right? If you're an investor in a fund, in an investment vehicle like an SPV or something similar, reach out to the GP manager and say, hey, I'm interested in selling my stake. What should I do? And that manager should be able to support you. Now, if you hold the shares directly, right, you are the manager of that investment vehicle, that fund. What I would always recommend doing is first and foremost, approaching the contact within the actual startup company, typically someone on the finance or legal team, right? Unless you have an existing relationship otherwise, and really just initiating a conversation around your interest in selling with them, right? To kind of give them that preemptive heads up that, hey, coming into an end of life cycle, looking to have some liquidity now, that company might have some sort of immediate ability for you to have a path towards that liquidity. And, if at the worst case, they say, hey, can't really help you, you kind of on your own, you got to go find an investor to buy that stock from you. Well, if that's the case, at least you gave the company a heads up. And then what I would do from there is kind of going into and kind of establishing where your relationships are with either funds and groups like myself and Hustle Fund, brokers, banks, and otherwise to really kind of sit at that merchant level to say they specialize in the transacting of secondary transactions.
One small thing that I would add there that is a possibility, depending on how kind of big your existing LP base is, but actually going to your existing LPs and seeing if anyone is interested in either transferring the shares, kind of like taking, crystallizing that gain, and or, buying that position out of the fund could be, I would say, a very easy kind of affiliate transaction where maybe you have an investor that wants that kind of like pre-IPO exposure, wants to hold it, much longer term, and can kind of help facilitate that transaction for an exit from the rest of the fund.
I have a small question about the mechanic of that. So let's say that I have a buyer of my secondaries, or who wants to buy these secondaries, and I need to transfer my shares over to them. Who's typically paying the legal fee for the transfer of ownership? Is it the seller? Is it the company itself that's just covering it? I'm not sure if I even know. It's a very small mechanical question.
It depends on whether it is the interest. So let's say you're an LP of whether it's a fund, an SPV, whatever it is. Typically, there's something arranged where there aren't necessarily big legal fees involved because that's a pretty straightforward transfer amongst LPs, which is what Jamie just discussed.
Yeah.
Obviously there might be a purchase agreement between the two, an LP purchase transfer agreement, but otherwise it is typically pretty limited. If you're talking about actually buying and selling the direct common or preferred stock from the startup, some startups do impose a legal transfer fee that could be split between the buyer and seller. Some companies have, a process that they say the buyer pays or the seller pays. And this is something where you're going to want to probably, establish that by way of an initial discussion with the finance or legal team of that startup to kind of get a sense of that procedure. Is there a legal transfer fee? I would say at the maximum over time, I've probably seen something around $5,000 as a one-time transaction fee to pay the legal bill of the company's lawyers to facilitate the transfer. But I would say that's probably the biggest extent of fee I've seen.
Yeah, I've done a version of this before, moving private shares that I owned into like a trust. So there's like a transfer of ownership there. And I have done a few secondaries too. And it looks like a pretty simple document from what I can tell. I think that the etiquette for those who are listening out there is to offer paying the legal fee, because it is a bit of an onus that you're imposing a bit on like the founding team or the company. But sometimes if the relationship is good, they'll just cover it, which has happened before too, which is where this relationship stuff is really matters. I mean, so, there's so many questions actually related to, the relationship side of things, and people are really digging the epic side of this story. So I'm not sure how much inside baseball you two can share, but one question was like, for companies like Epic Games, how are you able to attain access to financial information when the company is very strict with sharing access to updated financials? Is it just like an email, a text? Like that sounds tricky.
Yeah, I mean, I would say the following, right, is some of the kind of suggestive best practices is that it's always good that if you're going to want to receive financial information from the company, it's always a good idea to show that you did your homework yourself first to the best extent you can, which is scraping those online sources for publicly available financial information, coming into the company with a thesis that says, hey, I looked at the public comparables that are the publicly traded companies similar in the space. I checked all the available sources, and this is kind of the financial thesis I've built as an investor. Can you validate that? And many companies, just we've seen over time from our research team all the way up through our investment team, has been that they appreciate that you did that homework, right? They don't expect you to just to open the kimono to you just because you're asking. But I will also say that, depending on the company, right? Epic Games is a little bit different because they're just such a behemoth, but sometimes it just helps to ask nicely. Find the right person and ask nicely and show that you will be a value-add investor if an investment and transaction works out. But there are other ways to do it. I would say just covering the top two.
I totally agree. We always do our homework first. We basically do as much like financial kind of re-engineering as we can, literally creating a model from publicly available information, creating the memo, recreating the cap table, and we kind of come to them. And instead of saying, tell me everything, it's more like, can you confirm all of this work that we've done, or tell us where maybe we're off, and like maybe we can get some access to information. This is hard to do when you're coming in as like 100K, 200K investor. So this is something where scale definitely helps when asking for things like financial information and or long-standing relationships with the company. What else was I going to say on that? I don't remember. Oh, Epic, just a side note. I don't think that the financials are like super up to date at this point. But because of the lawsuit with Apple, they actually had to disclose a bunch of audited financials. So if you do like a deep dive through the internet and court proceedings, you can actually find a decent amount of financial information on Epic specifically.
That is cool. That's a pretty fascinating angle.
Investigative research. This job is actually very much like an investigative research.
Yeah, like forensics, like
it's forensic research.
CSI, secondaries, right? Starring two amazing forensics analysts here. Okay, I think we're about to run out of time here, but maybe I can slip in one last really quick question. And this is actually representing the more retail side, which is who gets to participate in these investments? Like, do you have to be accredited or a qualified purchaser? Can you be non-accredited to do this kind of stuff, to buy in?
I don't know of any platforms where you can invest as a non-accredited investor. I think there are some retail platforms where you can come in with smaller checks as just an accredited investor. A lot of what Andrea and I do is limited to qualified clients and qualified purchasers, which is a slightly higher threshold and actually a different set of regulations. I would say as an accredited investor, writing small checks kind of through these platforms, just make sure you understand what you don't know or can't know when you're coming on and buying common shares from employees, like without access to information, et cetera, et cetera. But it certainly could be a place where you can get access to some interesting names.
Okay. Well, with that, this has been a very fast hour. I had such a blast with you two. Thank you so much for this discussion. Thank you, everyone, for making time in the audience to talk about secondaries. Oh, perfect. I was just about to ask Jamie to flash some contact information, but I want to start by just sharing a huge thank you to Andrea Lamar. She is the queen over at Manhattan Venture Partners. That's MVP.vc. They're some of the best in the business when it comes to facilitating secondary transactions. And again, check them out at MVP.vc. That's easy. That's fun to say. And also, of course, a huge thank you. A huge thank you to my other amazing colleague, Jamie Melzer. She's the founder of HF Scale Partners, which is investing in growth stage companies. And Jamie, you're one of the smartest and coolest colleagues I've ever had a chance to work with in my career. You
Thank
should
you.
learn about
Yeah.
more what she's doing to deploy in the late stage. Check her out at hustlefund.vc/scale. And to answer finally the last question that everyone's asking, two things. Yes, this is a real garage. I can throw away garbage, so stop asking me that question. And the second thing, of course, is we did record this session. So if you did RSVP, expect a follow-up in the next day or so with the full recording. Andrea, Jamie, thank y'all so much.
Thank you, Eric.
Thank you.
Thanks.
Love you guys. Thanks so much.
Okay, see you at the next one, y'all. Bye-bye.